Ray Wang, principal analyst and founder, Constellation Research, joining us. We wanted to take a look at what your thoughts are on Alibaba. It's Investor Day. It's a name, obviously, that is a huge one, has obviously that China factor. Your thoughts?
Hey, good morning. It's wonderful. Alibaba is one of those, the part of the BAT group, right? Baidu, Alibaba, Tencent. And these are companies that basically are digital duopolies. They basically are built on what we call their social networks, their data-driven networks, the commerce, right? And they're basically diversified tech giants, kind of like the way we look at FANG stocks in the US. And what's really powerful about what they've got going for them at the moment is they've got a very closed market. Basically, you can't really compete in the China market, but it's also a very active market. They're doing everything from entertainment to AI to commerce to delivery services to banking. And that's really what makes it an awesome play, because what it's really doing is going after the entire China internet market. And it's basically the way we used to look at GE for industrial stocks. That's the way you should look at China internet stocks, is really what BABA is all about.
Yeah, I mean, I know that they're so competitive, right? And it's great that you brought in some of the others, Baidu and Tencent. I actually never heard that phrase BAT before. Markets are my life, but I never heard that. And I think you make a great point. Well, they have Singles Day, which they brought in obviously a ton of money. The TikTok shopping partnership. So what is the outlook for this kind of company, particularly in a somewhat volatile environment?
Yeah, so the challenge right now is that people wonder if the China trade is actually going to make an impact on their earnings. And the short answer is it's about a $20 to $25 overhang once the China trade resolution comes into play. But despite that, we're seeing lots of growth, everything from Ant Financial, which is doing amazing, to what's actually happening when you think about their latest acquisition, Kala, which is really about a commerce play, which they picked up for $2 billion, right? And when you think about these overall plays, I mean, they're basically set for the next 5 to 10 years. They think they're going to get to somewhere between 1 to 1.5 trillion by 2025. So these are some huge numbers that they're posting up there. And it's basically, they're getting growth from the China consumer market, right? So where they had the tier 1 market going forward, right, they're going to tier 2 cities. Now, think about it. A tier 2 city in China is like sitting somewhere like, it's like 10 million, right? It might be a tier 2 city, and that's bigger than most US or American cities that are in play. And so when we think about what's happening, this is, it's really about expanding growth in China, expanding growth outside. They also have a cloud play. The Alibaba cloud is actually taking a big role, not just in Europe and APAC, but also in Africa, where China has a massive infrastructure dominance. So we're going to see all these factors come into play. And this is why Alibaba is one of those leading stocks.
Yeah, and Alibaba had come under some pressure. I know year to date it's up about 33%, but I remember only because I had owned it and it sold off some. So it's not one of these stocks that goes straight up. But in your opinion, you really think this could be on its way up only because of the tier 2 and the opportunity for growth, right? I mean, is this a $200 stock, do you think, at some point?
Yeah, I'm looking at about 198, and then if the China trade comes off, let's say there's a resolution or trade deal, which I think probably looks less and less likely as the year goes out, you'll probably be able to see somewhere in the 220 range. But here's why, right? I mean, the fundamentals here are basically, when you think about the China market, they literally have almost every Chinese consumer in play from shopping. And so if you view them the same way you view Amazon in terms of the growth prospects, as well of the current pieces in terms of commerce and entertainment and the cloud, then you can also think about what the future looks like with AI and payments and thinking about what happens post AI in terms of what their ability to be able to deliver next best action, right? They're gonna have recommendations, they're gonna have digital feedback loops. And these are data-driven digital networks, which means basically they can anticipate market demand, they can forecast demand, they might even know the Chinese economy better than some of the bureaucrats.
Yeah, that's absolutely right. And when you talk about data and cloud, I mean, that is cha-ching material. Last thought I wanted to ask you, about some of the other Chinese stocks. Are there any others that you're watching as possible investments or that you just like straight out?
Oh yeah, JD.com is always great. JD has the back-end infrastructure to deliver for a lot of commerce. So if you're competing with Alibaba and you're a foreign brand and you want to get into the space, you're probably going to partner with JD.com, or you might partner with Alibaba. So they're a great one to look at. And then of course, Tencent's been amazing, right? I mean, from gaming to social network to commerce to entertainment to VC, they've basically taken the same path. Right, and so the way you view Tencent is gaming company that became an everything internet company, just like Alibaba's been a commerce company that's become an internet everything company, and same thing when you think about Baidu as well. So those are the three biggies that are in China. So kind of like the version of the FANG in the open world.
All right, a lot of fun discussing this with you. Ray Wang, thank you so much. Principal Analyst and Founder, Constellation Research. Thanks for that discussion. And now we're bringing in our own Tom White to take a closer look and get a look at these trades. What we should be doing when we look at this. As I said, it was a stock that I owned and some time ago, but it has some volatility. But as Ray said, the upside potential is there. What do you think when you look at this stock?
Well, I look at it immediately as a $180 stock right now. So I immediately look to the options market as opposed to just trading the stock outright.
Right.
And like you mentioned, Nicole, there's a lot of volatility in this name, even though we've seen a nice little rebound over the last month and a half or so to get back to that 180 level. We're seeing some pressure today based on the fact that there's news out there that Chinese government is actually putting people from their government into place in a lot of these Chinese firms. So they're starting to amp up that presence. And that's a big worry sign, or it could be a possible volatile worry sign for the markets. And I think that's why you're seeing a little bit of a pullback. But based on what Ray's analysis is on Alibaba going into their investor day, it's a 2-day meeting that starts today. And I just looked at the option market, and I wanted to do something short term. So I looked at the October series in here. It's about 25 days to expiration. And I wanted to take a neutral to bullish type stance on it based on what Ray was kind of opinionated about with this stock. And what I came up with was a basic, simple put vertical, where I'm doing something that's out of the money to the downside. So I'm giving myself a cushion to the downside from the current share price just below 180. And I'm selling the 175 puts in October and buying the 170 puts. Because of that volatile nature of this stock, Nicole, I want to stay risk defined on the downside in case there's some more news out on this stock that might negatively affect it. And you basically collect about $1.20 credit. It might be a little bit more right now. You might be able to collect $1.40 for that as the stock sold off here a little bit. But you see the break-even point there, about $173.80. So I'm risking about $380 to make about $120 per spread that you do. Now, the nice thing is you got about a 60%, a little bit more than 60% probability that short 175 put is going to be out of the money at expiration, which is what you want. So you're still taking... Are
you good with a 60-something% trade?
On a trade that you might be bullish about and going off of Ray's research, this is the way you might be able to play it to the upside while still giving yourself that maybe about a 4%, 3.5% cushion to the downside before you start getting hurt on that trade. Now, on the other hand, there's another strategy that you could use if you're neutral to bullish on this name, maybe a little bit more bullish on it from these levels. And what I looked at was just a simple calendar spread. Now, they report earnings on the 1st of November. So that means volatility is going to remain firm into that report. And I want to buy that type of option in the November 1st weekly series. And what I'm selling against that is a near term, October 4th weekly. And I'm doing it on the 185 strike. So it's a calendar spread on the call side, about $5 above the current share price. You're paying roughly about a $3.10 debit on that. And that's basically what you lose, that's what you're risking on that trade. But the key thing on this type of trade, Nicole, is that it's neutral to bullish because that 185 is the apex for your profitability on that. And so you can have a slow creep up to that 185 strike, but you've got duration in this. So you've got a little bit more than a month in this trade. And what you're looking at is it's a long Vega trade where you're buying the longer term November cycle, and we don't expect volatility to fall in there. We expect volatility to expand.
I like the difference on this trade. Max loss is $310, and your max profit is $365.
Yep. And that can actually increase because if volatility increases into that earnings report, and you're long that option that has that earnings event in it, if volatility expands, the price of this calendar expands, and you see right there with the break-evens about a 176 on the downside and 195 on the upside. So anywhere within that range, most likely that type of trade is going to be profitable. So you're picking the 185 strike as your apex, but it doesn't have to be right there to be profitable on this type of trade.
But it's based on the calendar, based on the company's earnings, and you said those are due out on the 1st of November?
Yep, the same day that those options expire. So that volatility will stay firm in that option series that you're long. And then as you get closer to October 4th weekly expiration, you can continue to roll that short option over and over to new weekly series. And what you do is you collect credits. So it actually expands your potential profitability, but also reduces that initial risk of 310. So it's a longer dated duration trade.
Right.
But the key thing is you need the stock to kind of stay within those price points.
And it's after the high-level delegation meeting.
Exactly.
Too, so that might be interesting. I know the talks are constructive at this point, but that'll
it's interesting, but like you said, it could remain volatile, and that's probably one of the nice points about the calendar spread. If we stay volatile, the stock even pulls back a little bit, that might keep the price of that calendar spread in a stable area or possibly expanding.
Tom White, thank you so much. Expert Trades, 2 options for you. That was great. Tom White.